This video will cover income and gross domestic product. We'll examine the components of GDP carefully. We'll look at C, which is consumption, investment, which is labeled I, G, government expenditures, and NX, net exports. We'll carefully evaluate the definition of gross domestic product. We'll examine the income, expenditure, and value-added relationships that tie it all together. We'll calculate nominal and real GDP, and then we'll also interpret the GDP deflator, which is a measure of inflation. Now, let's move in and get some context for what GDP was in 2019. So here we have nominal GDP. And it's usually the numbers that you're given if you see it on the news, and we'll compare and contrast what nominal means versus real. But basically, nominal is in today's money. So in 2019, how much consumption was there? Well, there was about $14.5 trillion. So these numbers are in billions, and it's 14.5 trillion for consumption. That's 68% of GDP. Consumption is probably the most stable component that you're looking at here on this slide. It's relatively smooth. It represents the consumption of goods and services by individuals like you and I. It's the consumption of goods. So it's goods and it's services. Now, there's also a component called investment. And investment is about just under $4 trillion. It accounts for about 17% of GDP. And that investment is made up of several components that are important. One would be personal investment, and that's considered residential housing. So when we buy a house and a house is built, it's an investment, and so people consider it to be an investment. So investment is included in there. But the lion's share of investment is the spending that businesses do on property, plant, and equipment, and research that they undertake, and that totals about 17%. Also, keep in mind that investment also includes adjustments for inventory. So when inventory builds up in the supply chain, that inventory is production. So remember, we're looking at gross domestic product. And the funny thing is, we're looking at gross domestic product. This is production, but it also reflects expenditures that people spend because we produce things and people turn out to buy them. So that's why we're looking at gross domestic product. We're looking at consumption. Now we're looking at investment expenditures. And we're saying, look, inventories can go up or down depending on supply and demand factors. And those are counted as a temporary investment. That's probably the most volatile component of investment is inventory on a month-to-month basis. Now, before we go further, I should say that consumption and investment, those two top components, which is about 85% of GDP, are heavily interest rate sensitive. So when interest rates go up, it becomes more costly to borrow. And a lot of people turn out to borrow to buy a car, for example. When you buy a car, that's in consumption. When you buy a washing machine, it's in consumption. A lot of people borrow to do that. And so that's where the effective interest rates come in driving some consumption and investment. Now, investment is highly interest rate sensitive. I mean, imagine house prices are related to interest rates, and the demand for housing is related to interest rates. And so when interest rates fall, mortgage payments will be lower, and so people tend to buy more houses. And then not only that, but businesses tend to expand. When interest rates are low, money's cheap, they'll tend to borrow. And so those first two components are very interest rate sensitive. A component that's not so interest rate sensitive is government expenditures, and that's about 18% of GDP. Again, just under $4 trillion. That's what the government spends on goods and services. Now, the final component is net exports. We often just say NX for net exports, but it's composed of exports, right? And exports are about $2.5 trillion, or 12% of GDP. That represents things produced in this country, which is why there's implicitly a positive sign in front of it. And so that's why it's part of GDP, it's positive. And there's the negative sign is for imports. So we import about $3.1 trillion, or about 15% of GDP, with a negative sign in front of it. So total GDP was about $21.4 trillion. Now, before we go further, let's ask ourselves, what happens if What happens if I buy a Japanese car? How does it fit into this? Well, if I buy a Japanese car here in the United States, it's going to be part of consumption. So it's going to be in that if I bought it in 2019, it'll be in part of that $14.5 trillion consumption. But keep in mind, that car wasn't produced in this country. If it was produced in Japan, and therefore we had to import. And it's going to show up, the value of that car is going to show up as a negative under imports. Now, let's say the car costs $20,000 to produce in Japan. It comes over, it gets into this country, and then maybe the car dealer marks it up, and then we have consumptions at $21,000, and then we have imports at $20,000 with a negative sign. So you see how that works. So when we import goods and services, we're not double accounting. And also keep in mind that the value of that car is income to the Japanese. Now, let's look a little more closely at the definition of GDP. GDP is the market value of all goods and services, of final goods and services, meaning the final sale, and I'll explain that a little more closely in a second. So it's the market value of all final goods and services produced within a country in a given period. Okay, so we say within a country, we got to put a circle around it, bound it somehow, and within a particular time period. Now let's look at the details. Market value. What do we mean by that? The value of final goods and services. So if I buy a car for $21,000, it's that final car that's counted in GDP, the market value of that car. It excludes all intermediate sales and intermediate goods that went into it. I mean, that car could have changed hands a couple of times before I actually paid for it. But we don't double and triple account. So it's the final sale of all those goods and services that are embedded in that car. And then we talk about the word all. It says all final goods and services. And so we're talking about legally sold items, not illegally sold items, but legally sold items, plus imputed rent for our house. So if we own a house, we're not paying rent for it, but implicitly there's an expenditure for that. It's part of GDP. And so the government makes an attempt at computing rent for your house, even if you own the house, because you're getting services from that. You're actually, you made an investment, but you're getting some service from it each and every year as part of production. At least that's how the government accounts for it. Now, also keep in mind that if you cook your lunch, right, then that doesn't count towards GDP because it wasn't a sale. You're doing it for yourself. But if you work as a cook, your wages, which equal the value of your services, do contribute to GDP. Now, also keep in mind that when GDP is presented quarterly, it's often seasonally adjusted. In other words, the seasonal cycle is removed via an approximation. The government tries to estimate, really tries to estimate the effects of seasonality. For example, we all know that the fourth quarter is a strong economic quarter for the U.S. because of the holidays, and so there's statisticians want to be able to extract the effect of holidays on the business cycle and how the economy grows. So what they do is they remove the seasonal trends and patterns to try to get at the long-term patterns and trends that are underlying in the economy, and pull out the effect of seasonality. Now, if you look at annual data, you don't have to worry about seasonal data because you're looking at annual data from one year to the next. All the seasons are already embedded in there. So you're not comparing various quarters. You're looking at year-to-year data. Now what we want to do is take a look at computing GDP from three different angles. One will be final sales, which we just talked about a little bit. One will be based on value added. And then we'll look at income, factor payments. Factors are inputs that get used over and over in the input process. For example, labor is a factor. Rent is a factor. Rent on, for example, on property, plant, equipment. Interest is rent on money, basically. And profits are the return to business owners. It's a return on equity. And those are all considered factors and factor payments. So here I have an example of bread being sold by a baker. But before the baker buys it, the baker buys the flour from a miller, mills the wheat, and the miller buys the wheat from a farm. And we'll call that farm the American Ag Inc. It's a corporation, corporate farm like they are today. We'll call the miller the American miller, and then we'll call the baker American baker. And I got 3 columns there, one for each of these organizations. And so let's take a look at the first row there, value of sales. So the American Ag, the farmer, sells $420 worth of grain. And that grain is sold to the American miller. Okay? Now, in order to produce that $420 of grain, the farmer had to pay $200 in wages, interest of $100, rent for $80, and had to make some profit, and that's $40 in profit, for total expenditures for that firm of $420. So you can see that the value added to that grain in this very simple example is $420. Now, the miller buys this grain of $420 and ends up turning around and selling it for $900 in the form of flour. And the miller adds value to this good of $370 in the form of wages from employees, interest of $60, rent of $30, and profit of $20, for a total expenditure by the miller of $480. That's the value added by the Miller Company, $480. That flour is sold to the American baker for $900. The baker flips it around and sells it in the form of bread for $2,150. But in order to flip it around, the baker had to spend $1,000 in wages, interest of $100, rent of $50, and profit of $100. So value added for that particular firm, the baker, is $1,250, which is the sum of wages, interest, rent, and profit. Now, let's compute GDP in 3 different ways. The first way is the simplest way. See this number right here? Right here. Remember, GDP is a measure of final sales of goods and services. And so this is the final sale for this wheat. That's one way of looking at it. The other way to look at it is, look, if you add up across this bottom here, the value added by each firm along the way, then that value added would add up to be $2,150. Okay? So, whoa, it ties out. Now, another way to look at it is income. So each of these organizations paid wages, interest, rent, and profit. That's income to somebody. So if you look at the wages, for example, 1570, if you can read that, 1570, I'm adding across the row there, $1,570 was the form of wages that went to labor, and then $260 went to interest, and you can see that $130 went to rent, and $160 went for profits, and that adds up to $2,150. So in this relatively simple example, you can see there's 3 different ways to tie out or get GDP to agree with each other. GDP is the final value of goods and services, $2,150, which is the value added by all the firms across these columns, and then it's the sum of income that people have earned. Now what we want to do is calculate GDP. Let's run some examples of how to actually calculate GDP. In this example, I'm going to calculate nominal GDP, real GDP, and the GDP deflator. And the example is pretty simple, straightforward. We're just going to assume there's 2 goods in the entire economy, bread and milk. We have years 1, 2, and 3. We have the price of bread and the price of milk. Think of this as in loaves, and this is in milk is in gallons. And so what we want to do is we want to calculate nominal GDP. So when you hear the word GDP or read the word GDP, and if there's no other adjective associated with it, it's almost always nominal GDP, which means it's in current dollars. So I'm going to calculate nominal GDP in current dollars. So let's calculate it for year 1 in current dollars. No, it's going to be simple. It's going to be take the dollar, multiply it by 100 loaves. This is the value of bread that was produced in year 1. And we're going to add it to to the value of milk produced in year 1, and we have $325. That's nominal GDP in year 1, based on the current prices associated with year 1. Then in year 2, it's the same calculation. It's going to be $2 times 200 loaves plus $3. The price of milk hasn't changed in this case, but the quantity has changed. And so here we have now GDP, nominal GDP in year 2 at $700. And if we did year 3, and I invite you to do the calculations, it'll come out to be $1,000. So if you go back in history, let's say it's year 4 and you want to go back and you look at GDP historically, you'll see 325, 700, and 1,000. That's nominal GDP. You're just looking at the past track record of nominal GDP. Now what we want to do is we want to extract the impact of prices going up. See, you notice this price doubled of bread. And we want to get rid of the effects of this doubling of the price of bread. And so the way we do that is we calculate real, because real measures the quantity effects of the production. Okay? That's what it's going to do. It's like real, your real wages, for example, is what can you buy in terms of goods and services with your money, and how does that change? That's real. So let's do the real calculation. So the way we do the real calculation is we're going to use this $1 price and this $3 price of milk for each of the periods and just change the quantities. So this is what I mean. So in terms of real, we have $100 in production of bread and $225 in the production of milk for $325. You say, wow, that's the same as this number. Yeah, when you have a base year and you start out at the beginning of the period, your nominal will equal your real in your base period. And here I'm picking a base. It doesn't feel like I'm picking a base, but I'm actually picking a base, saying this is the base year. And by picking the base year, I'm picking these base prices. Okay? You can actually pick any year you wanted to as a base in reality, because you can pick year 1, 2, and 3 at any point in time. You can go back into the 1980s and call 1988 year 1, 1989 year 2, and so on. Or you can go into the 1990s and call that year 1, 2, or 3. So there we have the real value for year 1. And in year 2 is simply carrying these prices forward and the new quantities, so that the only thing that changes is the value of output given these old prices. Okay, so there's the $3 carried forward. It really doesn't have much of an impact anyway, because the price of milk didn't change in that time period, but the quantity did. And so here we have real GDP of 500. And then for year 2 and for year 3 calculated, it's also 500. So now what we can do is we can figure out, well, what is the inflation that's embedded in these prices and from production? It's the inflation from that's associated with GDP, what was produced. And so the deflator is this. Deflator is calculated as nominal divided by real times 100. And that will be our deflator. And so in year 1, and so this deflator will calculate each year. So in year 1, it's going to be 325 divided by 325 times 100. That will equal 100. And your base year always starts out at 100. It always equals this multiplier that we have here. And this is just simply a multiplier. And what it does is it sets things to a nice even number. So it starts out at 100. If we just left it off, and which means we're implicitly multiplying by 1, then this would start out at 1. But people like things to start out, these indexes to start out as nice round numbers. And one starts out at 100. And you'll see why in a second when I do the next calculation. So the next calculus, that's year 1. year 2 is going to be $700, the nominal here, divided by the 500. And what we have is we're going to have 140 is our deflator. Okay, so here's the deflator here, and here's the deflator here. This is keeping track of inflation. So you can see, without even pulling out a calculator, that prices have risen 40% based on the quantities. We're weighting things by the quantities. And then in year 3, it's going to be 1,000 divided by this 500 times 100, and it's going to be 200. So right away we've seen that there's a jump of, this is our increase in our deflator index, and that's telling us how much inflation has changed. And if I get my calculator out, that'll be about 43% gain in prices here. So there's a 40% gain. These are outrageous numbers, by the way. I mean, we'd be near hyperinflation if we had these types of price increases. And it's just an illustration. But so you can see, here is the deflator year 1, 2, and year 3. So to summarize, nominal reflects current year prices, real reflects base year, whatever base year you pick, and then the deflator is an index of prices, and that when you look at the change in the index, that's the inflation rate for the given year. So to be clear, let me calculate the inflation rate using the deflator, and then we'll calculate nominal growth rates from the nominal numbers, and we'll calculate real growth rates from real GDP. Now, the inflation, start here, inflation is calculated as this. We're going to take the deflator, I'll call it DEF for year 2, minus the deflator in year 1, that gives you the change, divided by the base year, or the previous, I should be careful, the previous year, which happens to be the base year. We're going to multiply it by 100 to get it into percent form. So this is inflation in percent. And so we're going to take, the deflator was 140 from the example, divided by 100 times 100 gives us 40%. So the inflation rate from year 1 to year 2 is 40%. What that reflects is simply, using the data here, it reflects this change in prices only. That's what it's capturing. And then we calculate the inflation rate from year 2 to year 1. If we wanted to calculate the inflation rate from year 3, from year 2, we would simply do this, and we'd have 200 divided by 140 times 100, and that equals about 43%. So prices went up 40%, and that excludes the effects of changing quantities, and prices went up in between year 2 and 3 at 43%. Now, what is nominal growth? So nominal growth is calculated the same way, and that equals nominal GDP in year 1 minus nominal in year 2 minus nominal in year 1 divided by nominal in year 1 multiplied by 100, and that will give us 115% nominal growth. And in year 2, so it would be year 2 to year, year 3, it would be 1,000 minus 700 divided by 700 times 100 will equal 42% nominal growth. So there's our growth rates. Then if we want to look at real growth, by the way, when you hear discussions about real growth, even on the news or in articles in the newspaper, Often when you hear growth about GDP, growth rates, it's often real growth rates because that's what people really want to know. How did the economy grow? Not because of inflation and just prices. That doesn't do much. It's how did the economy grow in terms of the production of output, quantities. That's a bit different than what I just discussed earlier when I talked about nominal GDP. And I said, look, when most people talk about GDP as measured in dollars, they're referring to nominal GDP at current prices. And the reason for that is if you don't specify the base year, then talking about a real GDP amount in any given year is almost useless because you need to know the base year in order to know about real GDP measured in dollars. But when you talk about nominal GDP and you talk about nominal GDP in the year 2015, people know exactly what you're referring to. They can look it up in the history books. Okay, so that said, let's look at real growth from year 1 to year 2 in terms of real GDP. That's 500 minus 325 divided by 325, minus or multiplied by 100. And that is 54%. Again, outrageous amounts of growth, but that's just an example. Then we have year 2 to year 3, and it's going to be 500 minus 500 divided by 500 times 100, 0. Yeah, so why is that? And I wrote on top of it here. I kind of did the calculations also here. Real GDP didn't grow. And why didn't it grow? Come back up here is even though we had inflation and nominal grew at 42%, the economy really didn't grow. What you and I produced as output didn't change. And so that's what the real is calculating. That real growth rate, 0, that's really what the economy did. So now, before I end this video, it's always helpful to put things in context. And let me summarize by covering what GDP is not, or what GDP does not reflect. As we said before, it does not reflect illegal sales and activities. It does not reflect leisure. Leisure is a good. So when you study labor economics, you're looking at the trade-off between wages and the time people work in labor. It's traded off with leisure, worked versus leisure time trade-off. Then the other thing is sales of land and financial assets are not included in GDP because those sales are generally, it's not the value of what's been produced. However, so the value of a broker's services, a real estate broker or a stockbroker, the value of their services, it's value added, it's an expenditure, it's income to the broker, that's counted as GDP. The value of used goods are not counted, at least in this year's GDP, because it was counted in a previous year's GDP when it was produced. And the last item is this. GDP, while it's not a perfect measure of well-being, it's probably one of the best predictors out there. The problem becomes, how do you measure well-being? That's the difficult part. Some people measure it in terms of happiness. Other people measure it in terms of, well, how much stuff do we have? And how much stuff that we have depends a lot on what we produce. And it's kind of measured by GDP. Or you think about it as, well, our well-being often depends, or we often think of it as depending on income. And well, GDP is income, so the higher your GDP, the higher your income, the better off you are. It's not that easy, but it's close. So my point being is that GDP is not the perfect measure, but it's a pretty darn good one. And the people that criticize it not being a very good measure of well-being, I ask, well, do you have a better measure? And I don't think they have a good answer for that.